Hey guys, welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to go over the big lizard. So last week we talked about the jade lizard, so if you missed that one, go to find shows at the top of scroll down to Mike and his whiteboard, and it should be the last video there called Jade Lizard. So what we learned about the Jade Lizard is that it's a great neutral to bullish strategy, and when set up correctly, we eliminate our risk to the upside. So the same thing is true with the Big Lizard, but it's set up a little bit differently, so we're going to get into that today. So without further ado, let's get right into it. So with a Big Lizard, as opposed to a Jade Lizard where we have the sale of an out-of-the-money put combined with an out-of-the-money call spread, now we're dealing with at-the-money options. So with a Big Lizard, we have a short put that's at the money and a short call that's at the money, and we're defining our risk to the upside with our call by purchasing a wide call out of the money. So the difference between this and the Jade Lizard is simply that the two short options share the same strike, and that's at the money. We're still defining the risk to the upside, but when set up correctly, like you can see here with this blue arrow, we do eliminate our risk to the upside and give ourselves a neutral to bullish strategy to work with. So let's break it down a little bit further below. So again, when we're talking about an at the money put, we're essentially selling a put for credit, and what this does is gives us a larger credit than what we might get selling an out of the money put, which is why you see this arrow extend all the way to the downside. So we're definitely going to get a larger credit when we're dealing with at the money options, because as we've learned before, at the money options have the most extrinsic value, which is really what we're looking for when selling at the money or out of the money options. So in addition to this at the money put, we also have essentially an at the money call spread. So when we lay this down here, we've got the at the money call spread, selling that call at the money, buying a call out of the money, and defining our risk, but this trade is also placed for a credit. So when we combine these two strategies together, we have the Big Lizard. So let's break it down a little bit further with an example here on the next slide. So when we're talking about the Big Lizard, we want to make sure that we're setting up the straddle first, and then we're defining our risk with the wide long call. So as opposed to the Jade Lizard where we might look for 70% of our total profit to be on the put side and 30% of our total profit or credit to be on the call spread, really what we're doing with the Big Lizard is setting up that straddle first and then defining our risk, but making sure that our total credit is still bigger than the width of the call spread. So this is a big change in terms of how we set this up, and it's going to help us going forward in creating this strategy just so that we're making sure that we're collecting the most credit as possible, which is really important for our break-even prices. So again, setting up the straddle first if I were to place this trade, then I'm going to look to define my risk with the wide long call, but while I'm doing that, I'm still going to make sure that my total credit is larger than the width of the call spread, just like the Jade Lizard. So let's break this down with numbers here on the next slide. So when we're talking about setting up the straddle first, what we basically want to do is sell the put and the call on the same strike and the same expiration. So in this example, we've got a 70 strike, and let's say the stock price is also trading right around 70. So we've got this at the money strike, and we're going to sell a put and the call together for a credit of $5.95. So now I've got this credit of $5.95, which is really going to widen my break even here. So let's say this black line across the 70 strike is actually our break-even price. So the more credit we receive, the wider our break-even is going to be, and the lower credit we receive, the more narrow our break-even is going to be. So it's really important that we collect as much as we possibly can while defining our risk to the upside for the Big Lizard. So we've got $5.95 as our total credit. So now we're going to look at defining our risk with that long call. So I've got $5.95 here. I'm going to start looking at the 75 strike just because I know that purchasing this call is going to cost me something. I'm not sure what yet, but I know that since I've collected over $5 to the upside for the strike might be a good place to start. So I've got the 70 strike, I've got my naked put and call here. Now I'm going to define the risk with the call. So I look at the 75 call and I see that it's trading for 80 cents. So again, I've received $5.95 as a credit, but I have to spend 80 cents to define my risk to the upside. However, that still brings my total net credit to 515, and since that credit is larger than the width of the call spread, again, I've got the naked call, short call at 70, and the long call at 75, which brings my call spread to a width of 5 points. But I'm collecting more than that. I'm collecting 515, so therefore I have no risk to the upside with this trade. So this is how I would set it up when I'm looking at it, and that's what's really important to setting up the Big Lizard. Is it's going to be super important to make sure that whatever I'm doing, I'm absolutely collecting more credit than the width of the call spread, because that's what really eliminates my risk to the upside. Because again, when we were talking about the Jade Lizard, even if the stock price goes all the way up to 80 or 90, my short put's going to expire worthless and out of the money, but my call spread's going to be in the money. However, at expiration, I'll have to buy that back for $5 because it will have $5 of intrinsic value at expiration. So as long as I collect over $5, I'll break even or I'll make a little bit of profit. In this example, I would make 15 cents profit if the stock price was anywhere above 75 at expiration. So let's go to the next slide and we'll analyze this a little further. So we know what the Big Lizard is and we know what the Jade Lizard is. So let's break down some differences between the two and see what might be optimal in one account versus another. So when we're talking about Big Lizards and account size, I might look to place a Big Lizard in a medium to large account. So when we're talking about Big Lizards versus Jade Lizards, we usually look to place Big Lizards and underlyings above $75 and Jade Lizards and underlyings below $75. Now that's not a hard rule at all, but it's simply a guideline to use when we're looking for certain credits and certain ways for this to work as opposed to the other. So when we compare Big Lizard to Jade Lizard, a lot of times we'll place Big Lizards in medium to large account sizes and Jade Lizards in smaller to medium account sizes, just because the Big Lizard will likely have a larger buying power reduction when we're dealing with that naked straddle and then defining the risk, as opposed to out of the money options that are going to require maybe a lower buying power reduction. So when we go further, we're going to analyze this a little bit further, and it's still going to be the same. So when we're talking about Big Lizards versus Jade Lizards and underlying size, like we said before, Big Lizards medium to large and Jade Lizards small to medium. So again, we found that it might be optimal for Jade Lizards to be in underlyings under $75 and Big Lizards above $75, simply because when we're trying to sell an at-the-money straddle, so we're selling that put and call on the straddle price or the at-the-money stock price, when we're talking about smaller underlyings, it might be hard to get that large credit to widen our break-even points. So we might end up going with the Jade Lizard instead, which allows us to widen our strike selection as opposed to dealing with at-the-money strikes, and we can get pretty far out, collect that just over $1 credit, which we were talking about in the previous episode. And for Big Lizards, when we're looking at larger underlyings, it's going to be a lot easier to collect that bigger credit and widen our break-even points, which is really important for the Big Lizard. And when we're talking about assumption, these two trade strategies are exactly the same. So when set up correctly, they're bullish to neutral, and they're bullish when we collect more credit than the width of the call spread, because that eliminates the risk to the upside. So any upside movement will either let us break even after commissions or make a small profit. So let's get to the takeaways here for the Big Lizard. So the first takeaway is the Big Lizard is similar to the Jade Lizard, but a larger credit. So instead of selecting our strikes that are out of the money, we're looking at the money options, and our large credit greatly helps us widen our break-even point to be pretty similar to the Jade Lizard, but the mechanics of the trade will be a little bit different. Again, the Big Lizard is ideal for underlyings above $75 because when we're talking about that large credit, it's going to be a lot easier to obtain a high credit amount when we're selling at the money options when compared to a lower underlying. So if we look at an underlying that's $10 or $20, we're not going to get nearly the same amount from credit for selling an at-the-money put and at-the-money call as we might for selling it in an underlying above $100 or $150. Our third takeaway is that we'll look to capture profits earlier. So when we're looking at Big Lizards and Jade Lizards, since Big Lizards hold their value closer to expiration, so we know that extrinsic value stays around the at-the-money price. So if the stock price doesn't really move, it'll be harder to capture the majority of that profit until we get closer to expiration, because at-the-money options hold their extrinsic value the most because they have the most extrinsic value. So as time decays and we get closer to expiration, the options that are still going to have the most value are going to be those at-the-money options. So when we're talking about big lizards, we might look to manage them earlier, maybe 25 or 30%, compared to a jade lizard where we have our wide strikes and we look to capture about 50% profit if we can. And last but not least, when we're setting up the big lizard, we're going to set up the straddle first, then define our risk based on the straddle credit. So this is going to be the easiest way when I'm looking at it to set up the trade, because I can set up that straddle, I can see what sort of credit I'm looking at, and then I'll look to define my risk to the upside and make sure that regardless of what strike I select, I'm going to look for a very liquid strike and make sure that my total credit is larger than that width of the call spread there. So this has been an explanation of the big lizard. Hopefully you've enjoyed it. Thanks so much for tuning in. If you've got any feedback or questions at all, shoot me an email at support@dough.com, or you can tweet us at DoughTrading, @DoughTraderMike, or @. Until tomorrow, thanks again and have a great night.